And this is just the continuation of our previous video, which we were able to do on our previous class regarding the investors ratio. So in this case, we just want to look on the financial forecasting, and we are saying it refers to predicting and estimating the expected future financial needs of a firm. And this can only be able to, or can be enhanced through cash budgets. And then we have the percentage of sales method. So when you look on the cash budget, we are saying it is a cash flow statement which compare the cash flows with cash outflows. It should be the cash inflows with the cash outflows. Here should be inflows. It should be the cash inflows with the cash outflows over a given period of time. When you look on the percentage of sales method, we are saying this method operates under the following assumptions. There are some of the assumptions that we normally put in place there. And in this case, we are saying that there is a direct and constant relationship between the sales and various balance sheet items. For example, we are talking about the total assets and current liabilities. Two, we are saying that there is a relationship. There is a relationship which is expected to be maintained into the future. The firm is currently operating at full capacity, so that as additional financing can only obtained from the external forces. We are also talking about the dividend payout ratio is known in advance and with certainty, and the profit margin is also known in advance and with certainty. And that is why we are saying that under this method, a given increase in sales is to be supposed or is supported by an increase in the total asset. And that is why we are saying such increase in the total assets will be financed by an increase in the current liabilities and expected retained earnings. In case of deficit, the firm shall use the external financing such as the long-term debt. Hence, that is where we are looking on the formula for the computation of the external. There is a formula there which I will be able to analyze for you for the external financing requirements, where we normally look on the increase in total assets, minus the increase in the current liabilities, and also we subtract the expected retained earnings. For the students who are doing management accounting, it is very clear that when we discuss about the cash budget, that is what we already, that is the only thing that it is part of the thing that you tackle under the budgeting and budgetary control. And in this aspect, you can be able to agree with me that whatever we are going to be doing here shall not be different from what you tackled under the cash budget under management accounting. Is just the repetition and revision for such students. So in this case, I just want to do May 2017 question. There is a question there under the May 2017. It should be question 3A. Let us look for this question. May 2017. May 2017, we have a question here. I know some of us walikuwa shule, so 2017 question 3A. Is it May? Let me look at it. Sorry for this. Sorry. There should be financial management here. Question 3A. Someone reads.
The following information relates to Suma Enterprises Limited for the 4 months given below. Under sales, we have the month of September, October, November, and December at 60 million, 60 million, 70, and 90. All sales will be made on credit. Half of the debtors are expected to pay within a month of sale and are also expected to claim 2% cash discount. The remaining debtors are expected to pay by the beginning of the following month. And then we are given raw materials purchases in the month of September, October, November, and December at 20, 40, 40, and 30. Can you scroll? The firm plans to pay its creditors in full in the month following that of purchase. And then we have wages and salaries in millions, that is in September, October, November at 12, 15, 17, and 13. Additional information, all employees are paid in the month in which the wage or salary is earned. Rent of 10 million for each quarter is paid in March, June, September, and December. Other cash overheads of 2 million per month are payable. A new plant due for delivery in September will be paid in November at a cost of 25 million. On 1st of October, the firm plans to have 10 million in the bank required. The cash budget for 3 months ending in December.
Thank you so much. You can see you are being given a very simple question. I know that management accounting students will be able to enjoy this question. Come seeing the phones and then they come across it in the exam. Now, in this aspect, we have to be analyzing our question. And the first thing, which normally gives a leeway for the analysis in the first place will be the information which you have been provided there, where you're being told by the examiner that half of the debtors are expected to pay within the month of sale and are also expected to claim a 2% cash discount. We are also being told the remaining debtors are expected to pay by the beginning of the following month. In this case, when you look at it, the examiner is telling you to do the cash budget for the quarter ending December. So in this case, I have to be looking on my cells. When I want to come up with a solution for the above question, this is what I'm supposed to be doing now. This is what I normally do, right? And the management accountant students can be able to guide us. So in this case, we are saying that the first thing, start with the workings. We normally start with the workings, right? So in this workings, we're going to be analyzing our receipts. So I just want to copy my months. We have September, we have October, we have November, then we have December, right? So in this case, I just want to start by analyzing our cells. We analyze our cells there. So in this case, the examiner has already provided you the cells for the respective months, right? So for the first month, I can see examiner giving us 60,000. Let me just limit them to thousands of shillings. Thousands of shillings there. So the first one will be 60,000. The second one will be 60. Third one will be 70,000. Then the last one will be 90,000. Remember, this is what you are going to be analyzing. So underline like this. This is what you just want to analyze. We've been told half of the debtors are expected to pay within the month. So that is equivalent to 50%. So in this case, I talked about some of the money which you are going to be receiving on the same month. We are being told it is 50%. And when it is 50%, it means how much are they going to be paying with? We are being told if you are going to be paying within the same month, you're going to be given a discount of 2%. So in this case, can you allow me to subtract it directly and multiply here with 98%? Just allow me to do that, right? Just allow me to do that. So in this case, it will be, the first one will be 50%, 0.5 times 0.98. We are getting 49%. So 49% in this scenario is the one that I'm going to be multiplying with up there. Let me just write here, 49%. So this 49% I will be able to multiply directly with my cells. So I start with 60,000. The first one should be 29,400, 29,400, 0.49 times 70,000. I'll be able to get 34,300. And then the last one is 90,000. We are getting 44,000. 44,100. We are also being told on the same information that the remaining debtors are expected to pay by the beginning of the following month. And in this case, we can be able to talk about the remaining debtors who are occupying the proportion of 50%. So it means that the one who took goods on credit on the month of September will be able to pay on the month of October. And this will translate to around 30,000. So you'll be able to put 30,000 there. It means that that receipt will be received for the month of October. For the month of October will be received for the month of November. So I just include 30,000 there. For the month of November, which is around, I think it is 35,000, will be received for the month of December. So from there, we just want to look at our receipts. We are being told to prepare for the respective months, and those are consideration.
Excuse me, sir.
Yes.
Kindly just come again in that part of 50% by 98%. How are we getting that 49%?
So in 50%, you multiply by 98%.
Oh.
The 98%, it is that you are being given a discount of 2%. It means that the amount that you are going to be paid should be equivalent to 98%. You are not going to be paying the whole amount. You are being given a discount of 2%. So 100% minus 2%, so you get 98%. The proportion for the people who are going to be doing that is 50%. So when you combine the two proportions, badala ufanye 50% all through, ukuje utoe 2%, upate answers, ukuje tena ufanye 50%, just combine those proportions and you're not going to be having much of the computation to make. So let us just understand the receipts of the money which I have now in terms of the cash. The first one will be for the month of October will be 59,400. I know you can be able to ask me, why am I not adding for the month of September? Because it is not the requirement in my question. For the second one should be 64,300, right? The other one should be equivalent to 69,100. Hiyo ndio pesa najua niko nayo. That is the money that I have right now. So that is where I'm just combining between the two, and I'm not including the sales which I was able to analyze. I think we are up to we are together up to that point. I think we are together up to that point now. Now let us look on the let me look come up with a title for what I'm working on, and this guy is called Summa Enterprise Limited. Enterprise Limited. So in this case, you are doing, is it October to December cash budget? October to December cash budget. In this case, we just need to come up with the number of months here. We have we have November, then we have December, which is the last one. So in this case, the first thing that you normally start your question with should be the revenue that you have right now, right? And in this case, we are supposed to be coming up with the receipts that we have now. Na nikiangalia swali sijasikia kuna pesa ingine tuko nayo. So our receipts will be, the first one will be 59,400. This should be 64,300. Then we have 69,100 there. Then let us subtract our payments. Let us subtract our payments. There must be something which I'm not putting into consideration. Let me just put it a minute. Let me just put something here into consideration. And I will be able to tell you the fact that we normally start with the opening balance. We normally start with our opening balance. So let me look on the question whether the examiner was able to give us the opening balance.
In the month of December, Mwalimu receipts.
Sorry?
In the month of December, the receipts there, are we adding or what? That is 44,100 with 35,000?
It'll be equivalent to 79,000, right?
Mhm.
It'll be 79. I think it should be like that. Thank you. I can see under the additional information number 5, we are being told on 1st October, the firm plans to have a 10 million in the bank. That is our opening balance for the month of October. So you just come here straight away. I put here 10,000. That is our opening balance for the month of October. Then I will be able to add my receipts. When I look on my receipts, we have 59,400. We have 64,300 for the month of November. Then the last one should be 79,100. Now, because we don't have any other revenue, let us just do our summation there for the total revenue. The first month should be having 69,400. Remember the others we are not going to be adding since we don't have the opening balances. Let us go to payments now. Let us look on our payments. Now, in this case, when I look on the payments, I will be able to start from where I can see we have materials, the raw material purchases. We are being told that the firm plans to pay its creditor in full in the month following that month of purchase. So in simple terms, it means that the raw material that you're going to be purchasing for the month of September will be paid for the month of October. So in this case, I just need to say here, material payments or materials, right, will have a credit of 30 days. So for the month of September, we pay for October. Here we are going to be paid 20,000. For the month of October, we'll be paid for the month of November, that is 40,000. Also for the month of December will be 40,000. Okay. Now let us proceed. I look on the wages and salaries. I can see there, we are being told that the additional information, right? They have said that the wages and salaries, when I look at it in note number, which note is talking about this, note number 1, all the employees are paid in the month in which the wage or salaries is earned. So in this case, it means that for the October will be 15,000. We have talked about 15,000, 17,000, right? 17,000. Then the last for the December will be 13,000, since we are paying on the month in which they were incurred. Now, from there, we proceed to the additional information number 2, where we are being told that the rent of 10 million for each quarter is paid in the March, June, September, and December. So it means our rent will be paid in which month? In December. So here we talk about rent. For this quarter will be paid here. We talk about 10,000. And now from there after the rent, I can see we are being told that the other cash overheads of 2 million per month are payable. So in this case, we talk about the cash overheads of 2,000. Here we talk about 2,000. All that through. Then the last thing that I can see there, we are being told on a new plan due to delivery on September will be paid in November at a cost of 25 million. In November is when we are going to be making that payment. So we talk about the new plans, which will be paid in the month of November, 25,000. Yeah. Now, in this case, I can just be able to tell you, take your revenue or your receipts, take away your payments. Then what you're supposed to be giving in here, it is your closing balance. What is my closing balance? I just need to take 69,400 minus 35,000. It should be around 37,000. Getting 32, right? I think that my closing balance there should be 32,400. When I get my 32,400, which is my closing for the month of October, should be the opening for the month of November, 32,400 plus 64,300. 64,300. The total revenue which I have is around 96,700 minus 57, right? Minus 27,000. So the total which I'm getting right now should be 12,700. Right? Then you bring it up here because it's your closing for November, should be the opening for December. We talk about 12,700 plus 79,100, getting 81,800 minus 40,000 minus 13,000 minus 10,000 minus 2,000, and you are getting a closing balance of 26,800. 26,800. That is how you normally do the question regarding to the cash budget. That is how the cash budget is normally done. When we have this kind of information, the first thing you start with is by doing your workings, get the correct data. Sometimes it might be for salary, sometimes it might be another expense, and so on and so forth. You just need to do your explanation, or you're working based on the explanation given in the additional information. So I just want to do a question regarding to the percentage of sales method, and it was tested on November 2016, question 3A. November 2016, question 3A. Remember the question that we have done? It is a question for May 2017 here. This was question 3A. May 2017, it was a question 3A. Now, I just want to go to November 2016, question 3A. November 2016, question 3A. November 2016, question 3A. Mary can read for us. Mary can read, please. Teresia?
November, that is November 2016, question 3A. You can hear me?
Yes, yes.
Okay. The management of Georgia Limited wishes to establish the amount of external financial needs for the year ending 31st December 2016. The statement of financial position of the company as at 31st December 2015 was as follows. Plant and machinery, 31,200, furniture and fitting, 18,720, motor vehicle, 12,480, inventory, 19,200, account receivable, 14,400, cash and bank, 3,600. Then the total is 99,600. Financed by ordinary share capital, 42,000, retained profit, 17,600, 14% debenture capital, 10,000, account payables, 18,000, accrued expenses, 12,000. Total is 99,600. Scroll down, additional information. The sales for the year ended 31st December 2015 amounted to $120 million. The company forecast that sales will increase by 10% for the year ending 31st December 2016. For the year ended 31st, 2015, the after-tax profit for the company amounted to 18 million. The company adopts 80% payout ratio as its dividend policy. The payout ratio is expected to remain constant each year in perpetuity. The after-tax profit margin is also expected to remain constant each year. Assets are expected to vary directly with sales, while account payables and accrued expenses form the spontaneous source of financing. Any external financing will be effected through long-term debt financing required. The amount of external 12% long-term debt financing that will be required for the year ending 31st December 2016. 2. A forecast statement of financial position as at 31st December 2016. 3. Comment on 2 weaknesses of the method of forecasting applied in A1 and A2 above.
Thank you so much. You can see the question given here was relating to Georgina Limited, and in this case, you know very well we have said that the percentage of sales method normally operates under different assumptions, which you are able to cover earlier on. And from that aspect, we just need to be able to understand that as per the requirements, we are supposed to be coming up with just like analyzing the statement of the financial position. It is normally based on the balance sheet items, but we are going to be calculating the percentage of sales. So how are we going to be doing this? Let me go back to my board, and I'll be able to show you how you are supposed to be doing it. The solution for the question. Let me look for it. The solution for question here. A minute, please. Let us proceed. So in this case, let us come up with the workings for the balance sheet item. So let me start by doing my workings here. So we are going to be working with balance sheet items. Balance sheet items, right? So at the end of the day, what am I supposed to be calculating here? Should be the percentage of sales. The percentage of sales. So the balance sheet items, which I can see examiner was able to provide there. The first one should be the plant and machinery. So the plant and machinery, the figure provided there is at 1:200. And because we are doing the percentage of sales method, it means I'm going to be dividing my balance sheet items with the value for sales. In additional information number 1, we have been told that the sales for the year ended at 1 December 2015 amounted to 120,000. So I just need to divide here by 120,000 times 100%, right? So how much is this? So it will be that 1,200. That 1,200. I divide by 120,000. Right, getting around 26%. That is 26%. The second one will be furniture and fittings. The furniture and fitting is provided there. We are being given 18,720. Divide by your sales. And you multiply by 100%. So 18,720 divided by 120,000. Getting 15.6. 15.6. The next one I can see it is the motor vehicle. So a motor vehicle would be 12,480 divided by 120,000. multiply by 100%. How much are we getting here? 480 divided by 120,000, getting 10.4%. Right. Now from there, we proceed to inventory. So when I look on the inventory, I can see we are given 19,200. You divide by 120,000, that's 100%. 19,200 divided by 120,000, getting 16%. After the inventory, you can see we have account receivables. Our receivables are amounting to 14,400 divided by 120,000 to multiply by 100%. So 14,400 divided by 120,000, getting 12%. The next one will be, I can see we are looking at the cash and cash equivalents. So it should be cash and bank. So in this case, the value provided there is at 600. Divided by 120,000, you multiply by 100%. That's 600 divided by 120,000, getting 3%. What is the total for your current assets? So the total current assets, right? Or we can talk about the total assets, sorry. Total assets yetu ni ngapi? Total assets. And it should be 15 plus 16.26, sorry. 26.4 plus 15.6 plus 26. This translates to 83%. 83%. A minute, please. I think we have already analyzed our total assets. The only thing that I just want to analyze is the current liabilities. And because already you cannot be able to convert the ordinary share capital, retained profit, the 14% debenture capital. The next thing that we are supposed to be checking on should be the current liabilities. So in this case, I just write here. Let me analyze my current liabilities. And my current liabilities, we have only two values there, which we are supposed to be doing our computations. One should be the account payables. Should be the account payables. So the account payables for us should be 18,000. You divide by 120,000. You multiply by 100%. Right? How much should this be? So in this case, should be you just do your computation right, and you're going to be getting 15%. The other one I can see there, which is their accrued expenses. And the accrued expenses, we have 12,000 divided by 120,000 to multiply by 100%. This translates to around, I think it should be 10%. So at the end of the day, the total for current liability should be equating to 25%. Before we apply our formula for the external financial requirements, it is important that you have to be looking on the additional information number 2, where we have been told that the company forecast that the sales will increase by 10% for the year ending 31 December 2016. So in this case, we just need to be looking on the increase in sales. So our increase in sales, we just want to look on the proportion of the increment, and in this case should be, right, I was being told it's 10%, and our current sales is the equivalent to 120,000. So this translates to Kenya shillings 12,000. That will be the increment
of our sales. That will be the increment proportion of our sales. Now, in this case, I can be able to write my formula, the external financial requirements. The external financial requirements, we have said, just take what? You can be able to take the increase in the total assets. We take the increase in total assets minus the increase in total liabilities. The increase in the total liabilities, including, right? We are supposed to be talking about the expected. We subtract our expected retained earnings. We subtract our expected retained earnings. Now, in this aspect, I'm just going to be looking on the increment aspect so that I can be able to get my the external financial requirements in this aspect. So in this case, I will be able to have a column here. Let me just have a column of Kenya shillings here, limited into thousands of shillings. So in this case, because we have to be to calculate the increase the total assets, how am I going to be doing it? So in this case, I say, let me calculate it. I just want to take the proportion for my total assets, which is 83%. Then we multiply by the increase in sales, which we have computed here, and you are able to get 12,000, right? What is the increase in the total assets? What is the proportion? So I just need to take 0.83 times 12,000, getting 9960. 9960 there. You get 9960. I just want to look on the increase the current liabilities, and that is the deductions that we have to be doing. So we less the increase the current liabilities, right? Just subtract the increase in current liabilities. In this case, we just take the proportion for the current liabilities, which is 25%. We multiply it by 12,000. We multiply it by 12,000. In this case, I just need to take 0.25 times 12,000. I'm getting 3,000, which I'm supposed to be doing my deductions here. Then the biggest analysis should be based on the equity aspect. And in this case, I just want to be computing the expected retained earnings. The expected retained earnings. So in this case, my retained earnings, I will be able to start by computing my, I just want to start by computing the profit after tax. And that can only be done when I consider the formula where we use the net profit margin. The net profit margin should be equal to, we take the profit after tax, we divide by the total sales. The total sales in that aspect. So in this case, when I look on the year 2015, because there is an analysis for year 2015 and 2016 as per note number 3, we start our analysis for the net profit margin for 2015, right? Let us start with 2015 here. 2015 there. And in this case, when I look for the 2015, I could be able to see, the examiner was able to tell us that for the year ended at 1st December 2015, the after-tax profit, the company amounted to 18 million. In our case here, we use 18,000. Then we divide it by, right? Our total sales in this case should be how much? Our total sales will be equivalent, the current for the year 2015, we know very well is 120,000. Then multiply by 100%, right? 18,000 divided by 120,000, getting 15%. Getting 15%. That is for the year 2015. Now, in this case, we understand very well because we have already determined the net profit margin for the year 2015. It means for 2016, we don't understand or we don't know
the profit after tax, but we can be able to get it because when we were opening the year 2015, we had only two things here. We had the total sales because we have some speculation for the increase in the total sales by 12,000, right? And then we have the current net profit margin, which is equivalent to 15%. So you just need to say 15% is equal to the profit after tax. Then we divide by the total sales of hours. We just take 120,000 plus 12,000, right? That is what you just need to do. So in this case, it means in simpler terms, I just take 15%, I multiply by 132,000. This will be able to give us our profit after tax for the year 2016. 0.15 times 132,000. You'll be able to get, right, our profit after tax in the year 2016 will translate to 19,800. 19,800. Now, from that aspect, I just want to compute the expected retained earnings. That is what we require here, so that we can get our external financing requirements. So what is our expected retained? Our expected retained earnings in this case. When I look on the question there, we are being told somewhere, we are being told in note number 4, the company adopts 80% payout ratio. This is dividend policy. The payout ratio is expected to remain constant each year in perpetuity. So it means if, for example, we are going to be paying out 80%, it means our retention ratio will be equal to 20%. So it will be 20% of 19,800. 20% of 19,800. Remember, we are getting 3960. That is what we're supposed to be deducting here. Right? So what is your requirement? What is the answer of what you are looking? That is the external financing should be equal to how much? What is our external financing? And you can be able to tell me my external financing should be equal to 9960 minus 3,000 minus 3960. Here we are getting Kenya shillings 3,000. 3,000. That is how you are supposed to be handling the first requirement of the question. Now, when I look on requirement 2, examiner is asking you a very simple question to come up with a forecasted statement of the financial position as of that 1st December 2016, and he is able to give you 6 marks there, right? So in this case, to get our statement of the financial position, I remember for some of us who are doing financial reporting, you should be in a position to give us the a clue of how this is normally done. But the statement of the financial position, remember, we normally start with the title of the question. In this case, we are discussing about someone called Georgina. Should be Georgina Limited. Georgina Limited. Now, in this case, we are discussing about a forecast statement of the financial position. A forecast statement of financial position. Financial position is that first deck, the year should be already determined there, 2016. That first deck, 2016. Niliambiangwa, you normally underline that. So in this case, this is the part 2 of the question. And in this case, we can be able to start by looking the proportion provided here, and then you're going to be multiplying with the now the current total sales. Now in this case here, we just need to have a column here limited into thousands, right? And then we are going to be starting with the plant and machinery. I know very well now you understand our total sales should be equal to 120,000 for 2015 plus an expected increase of 12,000, totaling to 132,000. So for plant and machinery, I just need to take 26%. I multiply by 132,000. Right? How much am I getting here? So 0.26 times 132,000. We'll be able to get 34,320. Then we have second one, which is furniture and fittings, right? Which we got 15.6%. We multiply by 132,000. 0.156 times 132,000. We are getting 20,592. Now, the other one will be motor vehicle, where we are getting around 10.4% times 132,000. 0.104 times 132,000, getting 13,728. Then we have inventory. Our inventory should be 16% times 132,000. So 0.16 times 132,000, getting 21,120. The other one will be, you can look on the receivables of ours. The receivables, we were able to get around 12%. We multiply by 132,000. 0.12 times 132,000. We are getting 15,840. Then the last one will be cash and bank. We should be equal to 3% of 132,000. 0.03 times 132,000. We are getting that 960 here. What is my total assets? So plus 15,840 plus 21,120 plus 13,728 plus 20,592 plus 34,320. Getting 109,560, right? 109,560. Remember, just following the statements of the statement given in the question. So let us go to finance by. So finance by, when I look on the format given by the examiner there, we start with the ordinary share capital. We don't tamper with it. We just put the figure as given. Ordinary share capital given as 42,000. Right. We also have the retained profits. What is our retained earnings in this case? Our retained earnings. So when you look on the retained earnings, you just do two things here. I'm just going to be looking for the retained earnings for 2015. In this case, it was 17,600. Remember the computations that we have made. We have gotten for 2016 for the increments will be that 960. What will be the total for 2016? 3960. That is we have computed earlier on. We get our retained earnings to be 21,560. Now, from that, we can be able to proceed by looking on the 14% debenture capital, right? 14%. The 14% debenture capital, we are being told it is 10,000. It's 10,000. Then, when I look on the question already, we are being told about the amount of the external 12% long-term debt. That is what we have gotten under the requirement number 1. We are looking on the 12% long-term debt. What was our answer in this case, right? What was our external financing? And when I look on that, we were able to get our external financing equivalent to 3,000. You remember that is what we have gotten in our first computation. Now, the next one will be our payables, right? Our payables will be how much? Our payables, I will be able to take 15%, which is here, times 132,000, That is the only way you can be able to determine that. 0.15 times 132,000, getting 19,800. After the payables, we go to the accrued expenses, where we take 15% of 132,000. 0.15 times 132,000, getting 19. Am I getting the same thing? Sorry, this should be 10%. 10% of this should be 13,200. 13,200. Nothing else to add there. So what will be our total liabilities? In this case, we are supposed to be getting what? Let me try to check whether we can get the same as our total assets, 21,560. We have plus 10,000 plus 3,000 plus 19,800 plus 13,200. We are getting 109,560, which is the equivalent to what we got as our total assets. Your total liabilities. That is how you normally compute it. You see, I was not able to do any adjustments whatsoever. Then after that, I can see that part 3 of the question is asking us about the assumptions. I will just be able to give 2 assumptions because already you have them. We are saying the payout ratio is known with certainty and in advance. Payout ratio is known in certainty and in advance. It's known in certainty and in advance. The firm is operating at full capacity. That is another one. Firm is operating at full capacity. The firm is operating at full capacity. That is another assumption. You have all these assumptions in your notes, which I was able to share with you. Now, from there, I just want to give you an assignment as we conclude our topic for the ratio analysis. We do September 2015. Let me just write it here. September 2015. We do September 2015, question number 5. September 2015, question number 5. We have a lot of questions. You can even look to the current semesters and we look whether we will be able to tackle the question regarding to that topic. But from the way I have approached the question, I don't see any problem regarding to this point of computation of the percentage of sales method. Any question? Any question?